You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and today is 9/8/21. Well, there's a show that before I started podcasting, I listened to religiously, and even after, for many years, I listened to it. And it had a couple of different names, but the latest one was the Value Guys Stock Talk Show. And there was a couple of different co-hosts, but one person who was on it from the beginning, who started it, was Val Hughes. And he had a partner, Vern Value, and he had another partner, I don't remember, for a while. And then he had Momentum, but Mo took his own momentum and took off. But we're really pleased to have Mr. Val Hughes with us. He is, I don't know, are you a 100-year veteran of the stock?
Roughly, we are approaching that, Kerry. 100 anniversary is coming up.
Yeah,
and
not too long.
And we take gifts care of your address, so just keep those for us. Yep.
Yeah, with gift cards.
Of course. Yeah.
Recycled appliances, whatever you can afford, we'll take.
We like automobiles a lot. If any fans, want to step up for that, we accept cars and homes also. It's a big anniversary, so don't chintz out on it, I'd say.
Hey, so if you were going to send something to 1-800-CARS for kids, reconsider, although we're not tax deductible yet, but we are against.
Care of Kerry Lutz, definitely.
Got it. So, hey, you're like a walking anachronism. We were talking earlier, and you said if humans can't beat the damn computer at chess, how are humans going to win in investing? And that really is the question. What's the future of active management versus passive management? Do you just throw darts and just pick those stocks? Or do you actually need somebody like you who actually understands management, understands finances, understands business? Because a computer, all it could do is look for patterns and data in, data out. But there's certain data, like if you look at a CEO, you say, I wouldn't trust that guy with, if I dropped $10 in the street and this guy was behind me, he'd never even attempt to give it back to me. Computer can't figure that out, can they?
Well, you're depressing me, Kerry, because you're right. My craft is under siege. And so you might think, well, why would you need active management? Because your point, CEOs are going to mislead you. Accountants are going to mislead you. What's the point of it all? You can simply do what the Nobel Prize winners suggest. So, Bill Sharp and going before him, Markowitz, for you finance people out there, they took a stab at saying if you have a fully diversified portfolio, to your point, darts, if you have enough different stocks and they're non-correlated, again, to say that term out in the finance world, if they're non-correlated, then all the different risks of them going up and down cancel out. And you've also saved the fees that professionals that drive nice cars, because they don't all get them sent to them like the value guys do. Some of them have to buy them with the fees they charge clients. So I do think that ETFs are, the latest development for basically bringing investments, professional managed investments, to the masses at low cost. It's really kind of a distribution system. And the difference between ETFs and mutual funds, and I'm a big fan of ETFs, where I wasn't of mutual funds. And the reason is simply that mutual funds had a 40 basis point fee, that's nearly 0.5%, that they would charge for it to be available through Schwab or Fidelity or one of the big platforms. It was almost like a slotting fee to be in the supermarket, and mutual funds did not trade on the exchange. So they had this, in effect, membership fee that you had to pay to get access. ETFs, they trade on the exchange. So there's no platform fee. And so that 40 basis points comes out of the fee. And because they tend to mimic well-known indices, you don't pay as much in management fees because the index has already been created. So it's a wonderful development. So to answer you, I would say there's only a few little spots where active management can win. And the statistics will bear this out. Thankfully, Kerry, one of them is small cap value investing. So yes, the value guys, small cap value lives on. The craft of active management can, in fact, deliver alpha in small cap value. And this also has been proven. There's some gentlemen over there at the University of Chicago, Eugene Fama and Ken French. Listeners can go look this stuff up. They continue to publish. Ken French keeps a site at the Tuck Business School that shows that of all the different asset classes, small cap, mid cap, large cap, growth, core, and value, small cap value is the best performing asset class. And the data goes back to 1928. So not to give a history lesson, but the whole reason I do this and the value guys pursue this, and we encourage anyone to do it, is that if you like solving puzzles, there's still puzzles to solve in small cap value that can deliver alpha. But other categories in large cap and such, Kerry, not so much. I'd say in those, best to use the indices and use the ETFs in those categories.
Okay, so one thing that we've had, and it's been a really multi-decade trend, is the tendency or the actually the trend of concentration, where there's in industries, we've allowed companies to buy out their competitors and consolidate the industries. So there's really like a lot less out there to choose from. The number of stocks, publicly traded stocks, has actually declined over this time. And then you've got the companies buying up their own shares, and really they've just become this homogeneous blob, if you will.
Well, that is a very good point, Kerry. You know, what you have to sort of unpack to get behind that is why there are public companies. It's kind of a reasonably new invention. I think the East India Company, the Dutch and the English were early on this, and we're in their tradition. But it was to raise money to build things, factories and such that individuals couldn't afford on their own. If you really want to get a little cynical about it, you could say Wall Street was invented to help the rich families sell little pieces of their thing to an unsuspecting public, while in the back room they were printing more shares for themselves. There are some periods of Wall Street where that was going on, and I don't want to name names like Jay Gould or Vanderbilt, but those things were going on. But today, I would say, Kerry, there's a couple reasons. Your point is right. Public companies, there's fewer now than there were. It's a funny notion that in the Russell 2000, there's like, I think, 1,600 stocks. They don't have enough stocks to fill up the Russell 2000 with 2,000 stocks. The Russell 1000, I'm not sure, has 1,000 stocks. And the reason is, in part, it's a richer world. So we don't need as much public money because individuals can team up. 6 wealthy guys can now do what years ago you might have needed more people to do. Secondly, more of the economy is growing in areas where you don't need a lot of money to do it. You need a laptop, you need an internet connection, you need a library. Even the knowledge that universities are selling at high price Really ambitious people can just go to the library with a laptop and invent stuff now and plug in. So the need for capital to drive wealth has never been less than it was. And then in addition to that, the government, again, they're our wise government, they've brought a lot of regulation to Wall Street to supposedly protect the public, which then leads to fewer public companies, which then harms the public. So as usual, our government, unintended consequences by pushing too much on public companies in terms of disclosures and just legal expenses, and all this diversity requirement, which, if you just want to make a great product, the nationality of people and their gender, that shouldn't matter. So increasingly, the government is turning our public companies into more of a social good, which I don't want to weigh in on whether that's useful. It is in some regard. But true capitalists that are just trying to make a great product and win in the marketplace, increasingly the right path for that is to be private.
Hey, remember Sarbanes-Oxley, what that did to the idea of going public. So as a result, yes, we got way, way less publicly traded companies. And,
that's right.
And we got, so then this rise of private equity also has helped reduce the number of companies. Is private equity good or is it a bad thing?
Well, I think to the extent that you have to get back to what's the purpose of a company. If the goal is to find a product or a service that serves the public, and whether people buy it or not is their way to directly vote for that product to enhance their lives, then I think we all want that. You want people innovating products and services that enhance our lives. That's been going on for 10,000 years. It's brought us to a pretty good place, including long lifespans and comfortable lives. No hunger in the world. I mean, we can all point to our little eddies of problems in the world, but the problems we're having in the world now are tiny compared to most of history. And you can thank people that thought of ways to do things better or faster or cheaper to push that curve along. So private equity is still in the business of trying to turn that equity into a bigger amount of equity. And the way you do that is you create products and services that other people, the customers buy, and either you create a new niche with some new type of product and service, which of course is great and it's going on at a fast pace, or you come and do something better than other people, like Yelp versus the Yellow Pages, or Open Table versus calling 20 restaurants, or Uber instead of flagging a cab. I mean, we see examples all around us of faster, better, cheaper. And the innovators that figured that stuff out get outsized rewards. And, there's people against that. But if you don't promise rewards to innovators, then all the people trying to be innovators are going to stop. And most people fail. So in my opinion, it's a small price to pay to let the winners enjoy the rewards that have probably fueled decades of work and nights at the library and nights missing their families. And if we just keep that going, I think the future's bright. And I think private equity is a bastion of that effort. Yes.
All right. So here's one for you. We had these meme stocks, which are basically, for the most part, worthless garbage. Or if they're not worthless garbage, they're not the stocks in the market with the best future prospects, to put it charitably. And yet, we had this kind of anti-Wall Street rebellion saying we're going to get rid of the short sellers, we're going to blow them out, and to a large extent they were successful at it. What's your take on the Robinhood Reddit phenomena?
Don't just survive, thrive. The Financial Survival Network.
Fury Gold Mines is a Canada-focused exploration and development company committed to aggressively growing its scalable, high-grade gold assets with major drill campaigns planned across its 3.5 million ounce portfolio. Fury is led by a management team of proven explorers and developers with a track record of success in advancing and financing project development. Fury Gold Mines is well positioned to create value for investors with low-risk development growth and the potential for a new major discovery. Fury Gold Mines trades on the TSX and NYSE American under the ticker FURY. To learn more, go to furygoldmines.com. That's furygoldmines.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Well, the first thing on this is, again, it's an example of bringing something to the masses that used to require middlemen. You used to have to go to a room to watch people put on a play, and now you can click a button on your phone and watch Hamilton, wherever you want. So it's a matter of technology, I think, disrupting traditional channels. So historically, it was just the professional investors that were in the little club. Wall Street started with 20 guys under a tree. Those were the only ones that could trade. Then we had a long history of, you had to have a telephone and you had to know the guy's number and you had to have this and that. You had to go through a broker. Now I say what you're seeing is a leveling of the playing field. So the professional investors are having to compete with the guys on the street. And I don't think there's any problem with that. But what's happening is the two camps are evaluating different criteria. So the buyers and sellers over in the professional investor crowd, they're evaluating, the value of companies, the trading patterns of companies. They're trying to truly figure out what the stock's going to do. And that motivates their supply and demand for stock is these professional judgments. But over here in the same playing field are people that don't care about that or know about it at all. And they're simply going with, what the gang says to do. And what this reminds me of is I was a student at the University of Wisconsin, and I'd go to the football games, and about 3/4 of the stadium was really into the game. You'd cheer at a good play, you'd boo at a bad play. But then there was the section of the stadium that wasn't even watching the game. They were just drinking and swearing at each other the whole game. And that's what's happening. These meme stocks, they're off doing something different, but they're in our stadium here. So they're disrupting our trades. What I'm doing as an investor, Kerry, is simply, you got to pay attention to, in my opinion, and listeners of the show heard me say this a million times, what's the cash flow yield of the company you're buying? This is why I love equities. You're not buying stocks, you're buying companies, you're buying products. You can look at the products and see if they're delivering better value than other products. And you and I talked a bit about the quants and, commodities trading. I mean, the thing about small cap equities is there's products that serve needs. Even in a barter economy, you're going to need a space heater. So the thing I like about companies is you can look at Mr. Market. What's the value of the stock? That's your market cap. Add in all the debt, subtract the cash on the balance sheet. That's your enterprise value. And then if you look at the EBITDA or the cash flow and divide it by your enterprise value, that's your yield. And I think you can look at that just like a bond. Right now, the 10-year treasury is 1.5%. Or 1.4. The S&P 500, everyone thinks is expensive. It's 35 times earnings. That seems expensive. But let's flip that around. That's a 3% yield. And then it's going to grow 3 or 4%. So total return, yield plus growth. Equities are delivering still a vastly better return than governments. And so I think if you pay attention, government bonds, I should say. So I think with these meme stocks, again, they're in our stadium and they're making noise. But if we pay attention to to keep that metaphor, the plays, the players, the yardage. So I'm looking at cash flows and revenues and products, and I let those meme stocks do what they want. I will say that, for example, in the Russell 2000, you've got some stocks that don't belong in there, GameStop being one, or AMC. When when these people come in and they bid up these stocks for their own reasons, supply and demand is ultimately what makes stocks go up and down. So they've got demand for different reasons than me. But the problem is when you bid those things up to 10 or 14 or 15 or 20 billion in market cap, the long history of the Russell 2000 is small cap. So what really is happening, Kerry, is the Russell company, which, maintains these indices, they should do a better job policing the kind of stocks that are in their indices. Because once you have a 10 or $15 billion stock in there because it's been bid up because for whatever reason, in these cases, the mem stocks, they should be yanked out of there because you got small cap value people buying the Russell 2000 value, thinking it's small cap value. That's what it's been advertised as. But no, they've got some big cap growth stocks in there because of this mem phenomenon. And to me, that's the biggest problem with it is simply that. And I think someone needs to fix that. The Russell company.
Yeah. Well, there was a whole article about how companies lobby to get onto the Russell index, the 1,000 and the 2,000. I think they have a 3,000 also. Mm-hmm. And lobbying, and they're begging, they're pleading, they're threatening. So it's interesting that one company can hold that much control over the future. Hey, but let's look at how markets have changed. If you remember, Peter Lynch went up on Wall Street. Just go down to the local mall, see where the people are, buy that company. Well, now if you go to the local mall, it's kind of been taken over by Amazon as a distribution center, or it's an immigrant processing center, or it's a ghost mall and it's been closed and there's like weeds growing through the concrete. Things, investment trends and the economy, everything changes over time.
Yeah, well, the mall clearly is not going to be your best source now. Although in that same vein, I mean, I'm certainly a fan of Peter Lynch. I think he had, even to this day, some of the best numbers over the stretch that he was running the Magellan Fund. But I do think you gotta get outside your own skin, because when you're looking at companies, you have to understand how they're doing in the marketplace. And if you're not a customer or a traditional type of customer, then you have to understand your biases and think about, what the average person on the street might be thinking. So talking to cab drivers, talking to people just on the streets about what they're doing, what they're buying. I think for any investor, the thing to remember is the financial statements that they teach you over there at the university, they don't have the future in there. The future is in what people are going to do. It's their own, there's these, buying intention surveys that some people put out to get a sense of where the economy might go. But I think you got to go deeper than that. We spend a lot of time thinking about demographics, what people do at different ages. You might not even know what you're going to buy next year, but, the Consumer Expenditures Report knows, because they know what people a year older than you buy. So we spend a lot of time thinking about that. This period we're in now, Kerry, you got to think a lot about what people are going to be doing. One thing they're not going to be doing is, commuting to the office quite as much, or getting their suits pressed quite as much, or there's all kinds of things changing, and we got to be attuned to that. And I think you can't go to the mall because no one's there, but talking to people on the street in your daily life is really a good habit for investors to get into, definitely.
Yeah, well, and the concept of not going to the office for work, to work, that one, I haven't been working from home for years now, for almost 10 years. And I'd never go back to an office if I could avoid it, or they'd have to pay me a ridiculous amount of money to get me leave my house. And what's your take on that? Obviously, this is a somewhat permanent thing, maybe the hybrid workplace. You're working at home from some of the time and then from the office the rest of the time. It's got profound implications for everything in society, economically, socially, family-oriented, all these things socially. It's changing everything, isn't it?
Yeah, well, absolutely. I mean, I wrote about this, last year, just thinking about what COVID has done. And, what it really has done is it's educated all the employers that their workers can be productive at home. So it's done that. And then for workers, they've also seen they can be productive at home. We have daily research meetings over Zoom, so we're all still seeing each other and hanging out. And all of a sudden, the way I sort of thought about this was simply that there was a time in the 1800s when humanity invented factories. Up until then, you did work at home. Your home was upstairs, your little shop was in the first floor, or for most people, you were a farmer. I mean, let's face it, until 100 years ago, 95% of people were farmers and they lived at home. All of a sudden, factories were invented and they were tremendous productivity machines, but they required hundreds of workers to be shipped to the factory. And I think in the United States, Lowell, Massachusetts was the original factory, and they brought in farm people and got dorms, and all those early factory towns, they had to import workers, and hence the commuter was born. The commuter was born to bring workers to the factory. Then there's an office there to track how much you sell. Well, increasingly, the factory is moved out of town to cheaper real estate, but the office stays behind because that's where the contracts are. The lawyers have all the contracts. The money is in the safe. You still have a reason for people to be near each other. Meantime, the factories and the intelligent workers, they could work remotely. As you say, Kerry, I've been working remotely for 20 years as an analyst. You got your computer, you're on the road, what have you. But the downtown still needed the money and the contracts. And also all the employers still thought Kerry had to be at his desk or he wasn't getting anything done, even though you knew you were. Yeah. Well, now a lot has happened. All the richest people in the world, who tend to be the oldest people in the world, have now been lurched into a more productive future. Grandma learned she can take a picture of her check and it's deposited. She probably freaked out when she learned that. The fact that you can go on Zoom and you're in a meeting, again, grandma's freaked out. So it's a whole different world. So I think the people with capital have learned about these tools and they're never going back. And what I think about it as is just, we had to bring the worker to the factory in the 1800s to Lowell, Massachusetts, and we got kind of hooked on that. And now we've learned we don't. So I think, I forget what I titled my piece, but commuting over or something like that. Now, you still can go downtown. Cities will still have their purpose. Mating still requires a physical presence. So I think cities will turn younger. A lot of offices will become residential. That's pretty clear. There's still a reason for people to get together. I think a lot of cities will take a look at Epcot Center, see what they're doing to attract people. Obviously, you don't have to go there, but a lot of people do. So, and investors need to think about what's going to happen. That's why I say talk to people and find out what they're thinking. And it is a good path to the future to do that.
Absolutely. Well, it's going to be an interesting future. That is for sure. So, hey, we find you guys at the Value Guys. Hopefully you'll be recommencing the show in the not too distant future, because we'd love to hear you and Mo go at it. Mo has this just really sarcastic wit that,
oh my God,
always.
Well, bear in mind, Kerry, there are 300 shows out there. And the biggest joy we got out of the show was really educating investors about how to do it. We did it with fun. There's a lot of lessons there. They're still valid. History repeats. So certainly go out and listen to those shows. There's still a lot of value there.
All right. And I highly recommend it. And we're looking forward to the next 100 years with Val Hughes and with Momentum. Again, the valueguys.com, and I highly recommend it. Val, thanks so much for coming on the show. We will definitely talk to you again soon, and stay well and keep up the fight there for humanity, because they might be able to replace Val, but they can't replace Val's mind.
Thanks so much, Kerry. Great to be with you.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.